Morning, everyone. So this morning I'm just going to touch base on a few helpful tips on how you can work the buy, refurbish, refinance, rent sort of strategy when investing in property. This is it's a great strategy for building net wealth, for acquiring a property portfolio very quickly, and really making some momentum in your property journey. So these are kind of just my 11 top tips as such. So number one. The most important is to make sure your money doesn't get stuck. So this comes down to investing with numbers and not emotions. And it's hugely important that you don't get the numbers, the money stuck, because if you do, that's the end of your journey. You've got to wait years for the money to come back out, and you cannot then reinvest it to acquire more property. So I do that by over the years I've built a deal analyzer, I call it. It's a spreadsheet that looks at absolutely everything. You input your numbers, and from that it recalculates a load of sort of variations. So the flip viability, the refinance viability, how much money is going to get stuck, how long it'll take to get your cash back out fully, what the bridge and loan costs are going to be, what the mortgage interest rates and costs are going to be, what the monthly payments are going to be, the stress test monthly payments, and then it breaks it down into sort of the exit strategy. So if I rented, how much would I make on an annual basis? What are the projections for that? If I run it as a service accommodation unit, what are the projections for that? Or if I run it as a HMO or a mini mo, what's the projections for that? And then that allows us to sort of invest with confidence, and then decide what our exit strategy is going to be for the maximum profit. So by doing that, it takes all emotion out. It's a numbers game, and it'll tell us whether it's a good deal or a bad deal. Obviously, the information that we put in is crucial. You can sort of fluff the figures up to make the deals work, but that's not the right thing to do. So I do two things to make sure that I stay on the right side of the numbers. One, I factor in 20% extra on the build costs. There's always something that comes up that you weren't really planning for. And on the odd project where it doesn't, great, you're 20% better off. And even if 20% is probably quite high, but at the same time, it does give you that cover. And if the deal works with 20% in, then it's a great deal. Similarly, I take 5-10% off the top of the valuation price that I'm expecting once the value has been added. And again, that helps because valuers never really think how we think, and we always think properties are worth more. So, by taking the money off, it allows a bit of flexibility there in case it does get downvalued. And again, it's protecting that money and making sure that we're going to get as much of it back out, and we can push forward and buy another deal. So that's kind of how I run the numbers. In terms of the projects themselves, so initially you'll want to get a team of sort of not a team. You'll get 3 quotes for each of your areas. So if you're getting a kitchen or it needs a bathroom, you'll get 3 quotes for a bathroom. You get 3 quotes. This slows the process down slightly because you've got to get people in there. They've got a quote. You wait for their quotes to come back, and then you make decisions. So this can add sort of anywhere from 7 to 14 days on the project time, which for me isn't great. I like to be in there, get it done, and then get them refinanced and back out and using the money again. But at the beginning, you're going to have to do this because you haven't got the experience, and you're going to need to build this team. Don't always go with the cheapest. That's not the best scenario. That's how you can get burned. That's how people can run away with your money, and that's how you get really bad problems or bad workmanship, and therefore you've got to pay again to get it redone. Again, don't go with the most expensive. That doesn't mean they're the best. You need to be looking for recommendations. You need to be trying to see their work, and then make a decision. I probably would go with recommendations from good sources over anything. But again, checking their work out is a must. Once you get going, and you've done 3, 5, 6, 10 of these sort of projects, then you'll start to build a team of guys, and you'll work with these people regularly, and you'll build relationships up, and they'll know what you're after. They'll know that you're a good source of business for them, so they'll look after you. They know that you're savvy, so they cannot rip you off. But at the same time, they don't want to rip you off because you've got that relationship. They know that it's a you scratch my back, I'll scratch your back scenario. I'm the one that's going to bring you plenty of work. You're the one that's going to do the work for me. So if we all work together, we can all make decent money out of it because it's an ongoing relationship. And that's what we've got now. I've probably got 2 of everything. So 2 sparkies, 2 plumbers, 2 electric, builders, handymen, whatever it might be. And it just means that, because people do take holidays, and, sometimes they might be on other gigs as well. So they might not be able to jump straight onto yours. And as we want to be as in and out as quick as possible, it's always good to have a good team. And then you can just, quickly pick the phone up. I've got this. Do you want to go and quickly have a look in? It needs this, and this. And then you just agree the work, and you're doing it, and by building those relationships, for me, it's turned our portfolio around, because we can just get them in there, and they know what they're doing. They know how we want the places. They know what we expect. So they're not having to ring us all the time. Would you like us to move this socket over to here? Would you like us to? They just know what we would say anyway now, because of the sort of time we've been doing it. So that comes with experience. You can't buy that, unfortunately. But it is something that you want to work towards all the time, is building your power team, and just something you should have in the back of your mind all the time is, would these guys be a good fit for us long term? For me, I think about speed over costs to an extent. Obviously, costs are very important, but I won't deliberate over a percentage, or 50 quid, or even 400 or 500 quid here or there. If someone can save me 500 quid, but they can't get on to do the work for 3 weeks, well, I'll just take the person who's going to charge me more if they can get the job done in a week and a half. Because for me, it's all about getting the keys, getting the refurbishment done, and then getting the refinance, so we can get the money back out and in the quickest time possible. And then we want to be able to then go invest that money into the next property and do the same again. If I wait 2-3 weeks for somebody to do that, that's 2-3 weeks down the line. If I did that on every project, I'd end up pushing back. It's if we could acquire 4 properties in a year, spinning it quite quickly. If I wait 2-3 weeks, that might be 2 projects a year. You times that by 5, there's 8 less properties that you've got. And then, over a course of 5 years, 8 lots of £500 a month net cash flow, £4,000 a month, so your numbers start to, you've got to look at the long-term numbers as opposed to the short-term. And that's why I use bridging loans, or cash to purchase initially. And then from that, we get straight into the refinance. And I think the quickest we've done is 3 months. On average, it's about 3.5 to 4 months that we can go from keys in hand to actually getting the money back out. And, on that, and this is one of the biggest mistakes I made, was I stopped sourcing once I'd used up the funds initially, because I thought, well, I've got no more money to spend, so I can't be out there making offers. But this is one of the biggest mistakes I've made, because by the time you've then done your first one, you've got the money back in your bank account, you then back out looking again. It might take 2-3 months before you get everything through the mill, you get the keys in your hand, and you're wasting time again. So always be outsourcing. Also, if you generally haven't got the money, a good deal will attract money. If you're experienced in what you're doing and you can prove it, or you can back it up by using a mentor or something, you can get them involved, then people are buying that. Investors want to spend money. The bank's interest rate is terrible. Investors want to be putting their money elsewhere. If you find a good deal, someone will, worst case scenario, they'll buy it off you. But if you can't get it funded yourself, so you might be able to make, 2, 3, £5,000 selling it on as a source deal. But if you find a really good money in, full money out, or close to full money out deal that's going to, give a 10, 11, 12% net return, then, why is someone not going to buy that deal? Commit to a number of viewings. So this kind of comes back to sourcing. Everything is a sales funnel in property. It's no different. So, if it's 15 viewings a week, gets you 1 property, then, do 15 viewings a week. If it's 20, 25, whatever it might be, you'll work your numbers out as you get better, as you go through this and you get better and better. So, for example, if it takes you 10 viewings to get 8 offers, and 8 offers leads to 1 sale, and then you want to acquire 5 properties, well, you need to go on 50 viewings. But always have your number that you need to commit to a week, and make sure you're hitting that number. And by doing that, you'll grow your portfolio very quickly. You'll have a pipeline full of deals, and you'll be able to pick and choose the good ones. You'll be able to, decide if you want to sell them on, or whether you need to reach out to people for investor finance, and you can continually grow your business. Make an offer on every viewing. This is really, a lot of people say, well, what if I don't want the property? What if it doesn't suit, etc., etc.? I totally get that, but at the same time, it doesn't mean you're going to offer a sensible price. You know, if you don't want the property, you don't think it's a good fit for your portfolio, I always just offer a daft price. So, you know, if it's up for 70 grand and I don't really want it, I could just say I'll give you 35, 40 grand for it. But if someone accepts that deal, and we have had one of these before, they just want out the property, you know, their circumstances change, whatever it might be. You don't know that really. Then they might just accept it. You know, if you're getting a property 35, 40% below market value, there's going to be something you can do with it, you know, and that's a deal you shouldn't be walking away from. So, you know, put sensible offers in for the ones that you want, that work as per your deal analysis. And for the ones you don't want, just put stupid offers in. But those, you know, silly offers might actually come good, you know, and then you've got a really good deal there, and there's plenty of equity in the property, and I'm sure you can do something with it. Follow up every 2 weeks. Again, this is crucial. So make sure you're tracking all your viewings. Make sure you know who the estate agent was, the vendor was, what the website link is for the advert, you know, what it was listed for initially, when it was first listed. And every 2 weeks, just go back and just keep sort of saying, you know, is it available? Because you're not always going to get your offers accepted straight time, first time around. So by going back, you build a relationship with the estate agent for one, because every 2 weeks it gives you a reason to call them. They're then going to pass some other deals on to you. When you're on the phone to them, you can just ask, is there anything else? You know, you kind of know what we're looking for now. And so it does that. But then also, as that property stays on the market more and more and more, you know, 2 weeks, 4 weeks, 3 months, 6 months, and longer, that seller becomes more and more motivated to maybe drop that price down to maybe where your original offer was. So by just telling them that your offer is still on the table, you know, they might just pick the phone back up and say, listen, we've had Mr. Luke on, his offer's still on the table. Is it something worth considering now? They might say yes, you know, whereas 3 months ago, they were absolutely flat out no, because it was too low. So that is, and that also helps keep your pipeline busy, you know, because you're sort of reigniting offers and viewings that you've been on before. So that's kind of what I do in terms of, how we acquire, buy, refurbish, refinance properties, and how we keep the pipeline full of deals. And it's been hugely powerful in growing our portfolio. And as I said, you could quite easily grow a portfolio worth £1 million or excess in the next sort of 18 months doing this strategy. You know, it is a very, very good strategy. And the more you do it, the better you get at it, the quicker you get at it. And it opens a lot more doors for you as well. So if you've got any questions, drop them in the comments box below, and I will, I'll answer them as and when I see them come through. Don't forget to subscribe to the channel. And if you'd like to know more about what we can do, head over to our website, lukeholmesacademy.co.uk. Thanks.